I was in a money market account and I was getting, I think like 2% on it or something like that.
I did the research. It's
Yeah.
even a little bit less than that.
Okay. All right, cool. And it was just sitting there and I knew I wanted to invest it. And I thought, all right, this is it. I remember heavily thinking, you're like, Pablo, the best way to do this is to have a plan for getting to 3 so that your portfolio balances out. And I agreed with that, but I also thought there wasn't a better place for me to put my money in general. And if I had enough savings for a rainy day, that sure, maybe the experience of something happening in this property, the other one's paying for it, it's going to be different if it's coming out of my pocket. But I intuitively saw it as like the safe bucket with upside that I before was just in a safe bucket with no upside. And I wanted to get in.
We'll start to share with the people all this good stuff that led to this client journey here. Yeah. So there's our boy right there. And these are the 3 properties that you purchased at the different times. So we've got 2 happened in 2021 and 1 happened last year. So the first property was that one on Minosa in February of 2021. Let's see, we started the show in February of 2020. So this is like a year into doing the show.
Correct. Right. Exactly a year into doing the show. It took me about 9 months to read Rich Dad, Poor Dad. Thanks, Jen Filzen and Marilyn Cotterman for pushing me to do it. And Lee. And yeah, it was a year in. It was a year in.
And then we were probably, 6 months into twice a week runs?
Yeah, I would say, well, no, a little bit more. I feel like we started the twice a week runs in like April.
Yeah.
Like it was like right after the pandemic hit. I was like, I need to make friends with this dude.
Yeah. All right. So we bought the first one on Minosa Drive there and we purchased it for $127,000.
Yeah, feels pretty good.
And at that time, people looked at those purchase prices and they said, that's still high. Right? You still had people that were saying, listen, purchase prices are high. Like, why would I spend $127,000 on an asset? This happened to be on the lower side of the pricing for you, but these are smaller homes as well.
Correct.
In May of that year, we bought this property on Lucky Drive.
Correct. So when I bought Minosa, I knew I was already, it's February 3rd, right? 2021, right? Like I already had in my head made, and we're going to talk about it in a second, but I had made this like investment in Peloton on February 2020 that was going crazy bonkers. Yeah, that was crazy bonkers. And I instinctively was like, I can buy this first one because I think that I'm going to be able to reach 1 year with Peloton, take some of those chips off the table. And
for tax purposes.
Yeah, correct. I wanted
to wait a year.
Yeah, I wanted to wait a year to not get capital gain tax on cashing out of stock. And then I was going to be able to very likely buy another home and get to 2 at the very least. So I already kind of had that earmarked in my head on how to get to 2. I didn't know how I was going to get to 3, but I was already thinking that, which is why February this is bought, and then May we'll get into that linear story as soon as you want.
Yep. So we bought another one for $129,000, and then the third one here is the one that we bought last year, which is on Katina at $230,000. And we'll get into the decision-making process there. But as I started to think about your journey here, it hasn't just been from Pablo, the incredible volleyball player, to Pablo, the community creator here and chief architect of vertical integration and all of that. It's really been just a journey from Pablo as what we would call an average investor to Pablo as what we would call a not your average investor. And thank you to Facebook and the Facebook stalking skills that I have, that I was able to go and find this little gem of a beauty.
Brad, you see, so this is my first investment. This is Minosa. Tell me what you did here.
We went back in time in February of 2021, and this top section is if Pablo just kept doing what he was doing. And so at that time, his money was in a money market. Went back, and a money market returns largely track what the federal funds rate is at that time. And so I went back and I did an average of what the federal funds rate was from that time until now. And so it came out to about 1.7%. So while I don't know exactly what you would have earned, it's going to be somewhere around 1.7% on your money. If you had just kept your money there, your initial investment that you made in your first rental property with JWB had a down payment and closing cost of $28,575. If you had kept that money in that money market at earning 1.7% on your money each and every year since then, you would have returned a total of $944 for your total portfolio value be a little bit over $29,500.
Okay.
However, you didn't do that. All right. What you did is you put on a really spiffy suit. You put on a headset there. You got a nice mic, and you became a not your average investor, brother.
I did, yeah.
You bought that first investment property. And here are the actual returns, right? By you stepping outside the norm, investing in your first investment property, even though you don't know how many bedrooms and bathrooms are there, you're not in the nitty-gritty details. Yeah. You had an initial investment of $28,575. You've been able to earn $9,239 in returns from that investment. So your current portfolio value of this property is over $34,600. Each and every year, your internal rate of return comes out to a shade under 9% on your money.
Awesome.
Yeah.
Yeah. What are those returns comprised of, and the portfolio value? What's the difference between those?
I'm glad you asked. So the returns are made up of the 5 profit centers of rental property investing. So your net rental income, your tax savings, your principal pay down, your home price appreciation. And then the 5th one is inflation hedging and inflation profiting. You do have some of that working for you, although I didn't even count that into your returns there because it gets complex.
Got it. And listen, I'll say this property has been the toughest property, right?
Yeah.
This property had an eviction.
Yeah. I wanted to go deep into that.
Yeah. So I think that I love seeing this because this property is like the property that my wife and I most speak about.
Yeah.
I'm glad I'm going to get to show her this.
This is going to be great. So let's dive into what you've experienced as an investor, because I think there's a dichotomy between what people feel as a rental property investor versus what their returns say. And we can compare that to what they maybe feel as a money market investor, but what their returns say. Talk about what you've experienced and then how shocking this is to know that this is performed, call it 4 to 5 times better.
Yeah. So what we have felt going through an eviction is a combination, not in order, of fear, anxiety, and guilt, right? Like you definitely, I think it's really hard to own one of these things, know that there's like all these months of, because this was one of those where your team for a while was like, they wouldn't pay for a month or 2, and then your team would help them qualify for some kind of assistance. And then they would come up with the money and we'd get paid plus fees, right? So like it actually would end up looking really good. And then, but we saw the writing on the wall that this is a family that was going through some trouble and eventually this would probably happen. Then that happened, right? Then there was a long eviction process where we weren't very certain of like when we'd actually take control of the house or whatnot, because it's murky. I think it's harder to be in transition than it is to receive bad news or good news. So that was painful. And then it was like the repairs needed to be done and the time of filling it, right? So that was a time where there was money coming out of our pocket, and that led to a conversation over the dinner table every single time. Yeah. It felt like we've been losing money on this property. Right. So like it felt like we had lost a bunch of money on this property. And then now that it's filled and it's filled by a JWB screened person and we have a contract on it for 3 years and we feel great. I felt like you were going to show me this and that one was going to be negative and I was going to be playing catch up talking about future pacing. So the idea that I'll share it again, like the idea that, oh man, I'm just messing this up. The idea that I'm actually not just not playing catch up, but that my portfolio is worth more than if I would have kept it in Merrill Lynch is pretty eye-opening.
And what do you think is driving that? Like, how is that possible? We know that your net rent, we haven't met your expectations as far as net rental income. You had an eviction early on and it's hard. It's going to be impossible / really difficult to recover from that only owning it 2 years. Net rental income, we haven't performed, but there are 4 other profit centers, which is one reason why we love this. What's happened since 2021 that you just don't see and don't feel?
Home price appreciation. And not just home price appreciation, but what we're talking about, preserving capital. Even if it hadn't appreciated astronomically like it's done over the last 2 years, if this would have been in the stock market or something else, like chances that it could have been down or up 100% are totally different. And yet I wouldn't have felt that. That would not have been a dinner conversation. It would have just been like here's your statement from Merrill Lynch this month.
And even if it was, and we saw the statement and it showed that you were down 15%, there's almost a feeling like, that's what everybody else does. Everybody else is feeling that as well. You aren't the one who, did something different. Correct. And I think as rental property investors, these are really good conversations to have for you to share with everybody and for us to have, because you go through this emotional process. You're doing something different, and it's very hard to see the benefits of owning rental properties. And it's very hard to see. It's much easier to see the downsides of owning rental properties.
Yeah, totally.
Even though I don't want an eviction for you or 9 evictions for Medj.
Yeah.
But if we just look objectively at how your money is performing, withstanding all of that negativity, your money has been way more consistent and probably beat the returns of other asset classes, even though you've taken some punches here.
Yeah.
And that needs to be understood more. It's like, even in its worst days in rental property investing, it is more consistent and generally has higher returns on investment, especially if you understand smart debt. It just is very hard to, it's hard to understand. It's hard to keep it top of mind. It's a mission that I've been on and we've been on largely because of this platform, is understanding how beneficial it will be to make this easier for folks like you and your wife and others to see how well this asset class is performing.
Yeah.
8.8% is what we've been able to do, even
Pretty
though
cool.
you went through an eviction on that one.
Pretty cool. Pretty cool. All right. So this is my favorite one, the storyteller.
Yeah, let's
right?
talk about this one.
So my second one I bought, I think when Robinhood first became a thing, my buddy Nitin Sharma, shout out to Nitin, he was like, dude, there's this app, you can trade stuff for free. I was like, all right, cool, whatever. I started messing around. I was like, I put like $1,500 in an account, started messing around, put about $1,000 in Shopify, like 2016. By 2020, that $1,000 in Shopify was like $7,000.
Nice.
And then I'm sitting around and it's like late January. I'm hearing about this stuff coming out of China, this COVID stuff coming out of China. And I'm like, man, I wonder what's going to happen in Shopify if supply routes get disrupted. Because this thing, at that point, we just thought I was going to stay in China. Then at the same time, Whitney Ritchie, famous from the show, became like the 17th bajillionth person to try to sell me a Peloton because she wanted me to do rides with her and join her WhatsApp channel and blah, 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 blah. And I just put 2 and 2 together. I was like, man, this thing has crazy word of mouth. It's kind of the shared economy for fitness. And if this China thing is worse than I thought, then more people are going to be like working out from home and buying this thing. So I took the $7,000 from Shopify and I put it in Peloton. And 3 weeks later, the world shuts down. I don't think about it for about a week. And that Peloton thing starts going nuts.
Yeah.
Right. So I'm looking at it every day and I'm just like, man, oh my God, this $7,000 is not $12,000. Oh my God, this $7,000 is not what. And I'm thinking the whole time, I'm like, dude, I need this is going to be great. I think this is the next great company. But as my like thinking starts maturing and I buy this property on Minosa, I'm like, how am I going to get my next one? And I immediately was telling you, I was like, I think I want to cash out. I thought I was going to keep going up. I was just going to take some chips off the table and then buy it and then stay in Peloton and keep writing it out. And what ended up happening was on the year, like right at the year was right when like the COVID bubble of all these things started bursting. And it went from, I think I wrote you, right? I bought Peloton at like,
lost a bunch.
I did. But I bought Peloton at, I think I sent you something like at 12 a share. I ended up selling it at 122 a share.
Yeah.
But at one point it was at like 143.
Yeah, I remember it was even higher.
Yeah. So that thing ticked down. And then I was just like, man, do I just cash this out? Do I wait for this to come back up? And I was like, you know what, man? At that point, without the language, I was like, I'm going to preserve capital. I'm going to take these chips off the table. I'm going to buy the second home. I don't want to wait any longer. So I cashed out the Peloton stock and I bought this home.
Yes, you did.
Yes,
and let's see how this thing looks. So if Pablo kept doing what an average investor would do, and he kept that Peloton stock since May 17th of 2021 until now, it wouldn't have looked good, brother. It wouldn't have looked good.
What's I'm looking up the Peloton stock ticker right now. Peloton is at $8.21 a pop.
There you go. I looked it up yesterday and the markets were closed yesterday. It was $8.64. So it's even lost since then. Your initial investment of $29,025 in Peloton stock since then has lost $26,308 for a current portfolio value of $2,717. That is a 69.4% negative IRR.
Yeah. And that would have been down from this like valuation, but really I put 7 G's in a Peloton. So I still would have lost on the initial investment, but the pain of that would have been a real loss to me that I would have
that would have been crushed.
Yeah. And I think about like my buddies in my chat that we're all just day trading all the time, like holding on to it. All those games, they don't talk about day trading anymore. This one I'm particularly proud of because it took a certain level of discipline to take cash off the table.
I agree, dude. I agree. You were being a not your average investor by doing that, because at that time it was this, I mean, we were in an environment, there was so much money in our economy. The share prices were so high relative to what earnings were. They were just off the chart. And as we know now, a lot of that was just false. It was demand pulled forward for products and services and the age of easy money, which led to inflated stock prices, which is a part of Peloton's story. But it wasn't so clear at that time. You were the oddball by pulling out of Peloton and then going into rental property at that point. I hope more people see it the way you do, because I really think that this volatility that people deal with on stocks and bond, we've even seen volatility in bonds lately over the last couple of years. You don't have to just accept that. There are other asset classes that you can also enjoy the experience of being an investor in. And I hope more people open up their eyes to rental property investing and others, because it can be a bumpy ride. But as we look and see how this actually turned out on 71 Lucky Drive, this is your second JWB investment property. This thing's been a home run. How's the conversation of Lucky Drive for you and your wife? It's all kind of lumped in together?
It's all kind of lumped in together, man. Okay. Like Minosa has definitely tainted the conversation at all.
Yeah, makes sense.
For sure.
So Lucky Drive, your initial investment for JWB in terms of your down payment and your closing costs, that same $29,025, except you've returned $17,430 as a byproduct of those 5 profit centers for your current JWB portfolio value to be over $43,000. Your return on investment, your IRR over these 2 years roughly that you've owned it, is 21.7%. That means you've earned 21.7% on your money each year for these 2 years. And instead of a portfolio value of a little bit over $2,700, we've been able to grow that thing to over $43,000, brother.
Not too shabby. All right. So that's number 2, right? That was a little bit further from the beaten path, right? I just took some stuff out of the stock market and in, but it wasn't the traditional stuff in the stock market. And like, I'm really happy with this one. Third one was way different. Like this, at this point, things got weird.
Yeah. Do tell.
Right. So at this point, I knew that the window was closing on the opportunity to lock in low interest rates.
The deal is the debt, baby.
The deal was the debt. And we talked about it for a really long time. And I knew that there was a closing window for that. And I also wanted to get to that third property that we preach about, that you've told me a lot about, this idea of diversifying my real estate portfolio. So and it was when we first started, everything started going bananas on, like, in the news about there's a recession coming, right? So this was the end of 2021, right? Yeah, because I bought it in July 2022. Oh, no, it is July. Yeah. So July, it was at the end of 2021. I saw that I had this old IRA that had about 100 grand and change in there. And the first blip happened. The first blip where that 100 grand and change went down to about 90 G's. And I guess I had the muscle memory from the Peloton stock of thinking, hey, there's always a shot across the bow before the big thing happens. And I remember thinking, all right, I've got this thing there. I don't have enough to buy a property in cash and contain it inside of my IRA if I went self-directed. What about if I just cash this thing out? Like, would I be able to just pay the penalty, pay the taxes that have been deferred, pick up another rental property and avoid whatever was going to happen in the stock market and just lock in this debt that has my leverage working for me at like 14 to 17% based on the shows that we had been doing and whatnot. I went to my financial advisor and I was like, hey, man, I'm going to do this. And he's like, you're crazy. Yeah. Wait till I publish my newsletter that's all about time and market. And I'm like, okay. It's coming out tomorrow. And I was like, okay, I'm going to give it 24 hours. I read the time and market thing and I was like, this is no different than the time and market that I want to be in real estate. Yeah. And in real estate, it's going to be higher. Yeah. So I went against his best wishes, cashed it all out, broke his heart. I don't know if he's still my friend, and then decided to move forward with this home, which was the most expensive one that I've purchased. But I also, again, I look at this in buckets. I was like, hey, this is my last time for a while that I'm going to put in this bucket. So I had the opportunity to buy this home for $221 or a home that was like $160 that was also on the market. I decided, you know what, I'm going to pull forward demand and I'm going to just overinvest into this bucket because I know that this is the bucket that's going to set me up for the future while I mess around with my business and other things that are more active and more high risk, high return. So I pulled the trigger.
It was an incredible move. It was something that you approached me and said, "Hey, this is what I want to do." And we talked through the numbers of it. And if you believe that interest rates were lower than they're going to be in the future, and if you have a buy and hold mentality, and at the core of this, what you said is you wanted to be in a different, better asset class, then you were going to, and if you thought that the market was probably not on exactly stable ground, all those things from a different perspective make sense as to why somebody would actually pull money out of their 401k or their IRA and to accept those penalties, and why you would still wind up with a better return on investment. I will add, though, that you do not have to take the penalty. It made sense for Pablo in this case, but for all of you out there, many people have the misconception that if you invest with your 401k or with your retirement accounts, that you are forced to take these penalties or forced to pay the taxes on it. That is not the case. It made sense for Pablo here, but there are a number of strategies that you can do something similar to what Pablo did here without incurring those costs and those penalties.
Yeah. Yeah. And Kelly's asking me in the chat, what led to me deciding to cash it out versus buying in the self-directed IRA? What I can tell you, Kelly, is I was afraid of having enough capital in the self-directed IRA to contain the investment inside the self-directed IRA. And at the time, the thing that really seduced me was the debt. And the debt that I could get on a conventional loan versus a non-recourse loan was very different. I really, really wanted to lock in long-term, this historic smart money that I wanted to leverage. And that's the reason why I did it.
That is the greatest decision right there. The debt is the reason why this was such a great decision at that point in time. And you're going to look back in 5 years, 10 years, 20 years of owning this property. And you're going to look back at the interest rate that you got and you're going to go, wow, that was awesome. Even though in the short run, it was very likely that this was not going to be a better return on investment in the first year or 2 years, simply because we had a 10% penalty that we had to overcome. And you've got other things that kind of weigh down the investment right off the bat. So it was all about the long term, brother. So Pablo's third property on Katina Drive here, he hasn't owned it for very long. And when you start to run IRRs, unless a client has owned a property for 2 to maybe 3 years, it's counterproductive to run an IRR. And we can go more and more into that if we have time. But ultimately, we don't produce IRRs for client portfolios if they haven't reached that 2, maybe 3 year threshold. So Katina is only 1 year in, so I don't have an IRR to report here, but I do have your initial investment, which is $69,575. Your total returns from all 5 profit centers of $34,362 for a total current portfolio value over $91,000. What I can tell you is, even though we don't have the nifty little IRR calculation because of the short amount of time you've owned the property, you're shaping up really good on this one.
Yeah, feels like it.
And comparing that to what you would have done, it's great to see that you would have done quite well in the S&P 500 as well if you had kept it in that 401k.
Yeah, true.
You would have earned a 16% IR if you kept it in from that time. The market was depressed at that time. It has since gone up, which is great. You would have been in a good spot there, but long-term, this decision is going to be paying dividends more and more the longer that you hold on to it.
Yeah. And to me, the big thing here, being that it was my third property, whatever I would have done in the S&P 500 was less valuable to me than the idea of having the 3 properties that I could rapidly pay down one with the cash flow of others and get to the point where I could take debt out on the equity of the existing properties to buy myself more properties.
Right.
So that S&P 500 return was not going to spawn other S&P babies.
Exactly.
Whereas to me, this idea of having the 3 homes and the equity that you gain and then being able to play the financial engineering game and the leverage to then buy other homes a la Hervé Francois is what I was really trying to accelerate.